In this video, I'm going to cover two things: the potential fallout of two large banks in Europe, and what this means for investors, jobs, and the economy moving forward. Let's begin. First, going to rewind and mention the critical moment that led to the 2008 recession, the collapse of the Lehman Brothers, who at one point managed $639 billion in financial assets. The company handled mortgage-backed securities and collateral debt obligations. Then came the collapse of the subprime mortgage market, where the Lehman Brothers soon followed. Many critics believe Deutsche Bank and Credit Suisse may have a Lehman Brothers moment soon. Credit Suisse manages around $1.45 trillion in financial assets. According to The Street, 1 year ago, Credit Suisse had a market capitalization of $22.3 billion, but now has only $10.4 billion. The company's shares fell a whooping 56.2% in 1 year. Recent events leading to their financial woes came from a couple scandals that occurred within 1 year, one of them being Greensill and the other Archegos. First, Greensill, a British company who packages debts of companies that they lend money to into financial securities to then resell to investors. Investors of these packaged debts, according to The Street, backed out after questioning the value of these debts, causing the British accounts receivable lender to file for bankruptcy. Credit Suisse had $10 billion invested into Greensill. The second scandal came from Archego, a capital management firm, who used Credit Suisse and other banks' funds to invest in ViacomCBS, whose shares later crashed in March 2021. Archego, unable to cover the losses, had to file for bankruptcy. And the scandals doesn't stop there. According to Investment Monitor, in June 2022, Credit Suisse was found guilty by Switzerland's Federal Criminal Court for failing to prevent money laundering, which the bank denied, by a Bulgarian cocaine trafficker. The scandals, along with the loss of talent in the company and the spike of credit default swaps, or CDS, has the company on the ropes, where they are looking for a potential second win through a much needed but painful restructuring of their business. So in short, a CDS is an insurance against the risk of investments that allows an investor to offset or swap its credit risk with that of another investor. This may mean that more investors are looking to mitigate their risk. Thus, the market may be protecting itself from the potential collapse of Credit Suisse. Now, Deutsche Bank manages about $1.3 trillion in financial assets. Within the same time frame of Credit Suisse has seen its own stock drop 27%. The bank suffered its own legal trouble, where an internal probe found that Deutsche Bank had committed tax fraud. According to an internal investigation, they allowed clients to siphon off millions of euros in government revenues. According to a report through Seeking Alpha, the bank's stock is clearly undervalued, where they are trading at extremely low values, as if they were in the process of liquidating already. But compared to Credit Suisse, Deutsche Bank seems to be in better shape. A graph on Seeking Alpha shows after 2019, net revenues grew for the company and are projected to total between 26 to 27 billion euros. In fact, a quote from an investor on Bitcoin says, "Investors should avoid Credit Suisse and buy Deutsche Bank." So what does this mean for the economic world? Well, in a sense, the Credit Suisse situation may seem like a repeat of the Lehman Brothers. Lehman talked a good game about their financial position before the rug was pulled up from under them. Their fallout led to thousands of jobs lost, banks shutting down, massive foreclosures, thus bringing the U.S. economy to its knees. The CEO of Credit Suisse, Ulrich Körner, claims the company is facing a critical moment but has a strong capital and liquidity position. However, Wall Street Journal member Spencer Jacob believes Körner is ignoring the market concerns, and in doing so gives the big bank a bad look. Investors have raised concerns about the fate of Credit Suisse, and media outlets are gobbling this story up. According to Investor Monitor, some are blaming investors for causing market anxiety, which has driven up the CDS and caused the stock prices to fall. But anxious investors have a period of watching the CDS and stock prices ahead. This could possibly bring the quality of the loans that these two banks provide into question. Given the long history of scandals and legal troubles of both banks, it could be understandable for people to have skepticism, with one account even saying on Twitter that the fallout of Credit Suisse could shut down the credit market. So, my thoughts on the situation. Well, again, the Lehman Brothers managed $639 billion before they collapsed, and their demise affected a lot of people. But now we're talking about not one, but two huge banks, with a combined $2.8 trillion in financial assets. Imagine both collapsing, what that would do. That's why some are saying that should another recession take place, it could be more catastrophic than 2008. No company, large or small, is exempt from insolvency. So as an investor, do your due diligence before you make an investment with any company, while also monitoring signals to indicate the best time to buy when the market is low. Anyways, I hope you enjoyed this video. If you did, please leave a like and comment to share your thoughts on this subject. And please, don't forget to subscribe for more content like this. Take care and see you in the next video.